baby. Every day at this time, OBMMI, they provide the most comprehensive, accurate, timely, and interactive analysis of pricing ever conducted in the mortgage industry, calculated from actual locked rates with consumers across 42% of all mortgage transactions nationwide. And I still have to stutter at that one because until about 2 weeks ago, they had a 35% market share, and now they're at 42% market share. Let's see what the rates did yesterday. We don't know the APRs. We don't know points paid or points received, but we know what the rates were because that's what they tell us. 30-year conforming, 6.435. That was up a little bit. 30-year jumbo, 6.539, down nicely. 30-year FHA loan, pretty flat at 6.381. USDA loans, that's for the rural areas. Generally no down payment, 6.415. And I don't want to report this one, but I will. It's the best loan on the market, and it went up yesterday. This is the 30-year VA loan, went to 6.104. Can't just apply for that one. You have to earn it. And our veterans, every one of them, they've earned it. We appreciate the service. Let's see what's going on. The 10-year Treasury, flat. S&P 500 down 18.24. Mortgage-backed securities are down 20 basis points, which is not good news. That means interest rates are going up again. Ow! Yeah. So we're going to see that inflation number tomorrow. I told you about that a little bit in the last segment. Senior loan officer survey, the Fed's senior loan officer survey, which was done around a month after the Silicon Valley Bank collapsed, and there are more banks going to collapse coming up, so we know that's going, showed that lending continued to tighten. Banks most frequently cited an expected deterioration in the credit quality of their loan portfolios and in customers' collateral values, a reduction in risk tolerance, and concerns about bank funding costs, bank liquidity position, and the deposit outflows. They leave the headline till the end in that one, right? Because we know the problem is the bank outflows and their liquidity because of the mark-to-market problems that they're having, and the Federal Reserve causing all of them. If they hadn't raised interest rates so fast, in such a short, so fast, we wouldn't have had that problem. Think about this. It took from 1940 until about 1980 for the Fed to double interest rates. Oh, yeah, and they did that from April until December of last year. NFIB, Small Business Optimism Index, that's not a good one. Survey fell to the weakest level in over 10 years, with almost all of the components weakening. On inflation, compensation plans and higher selling prices moderated. The earnings outlook, capital spending plans, and those that expect higher sales all dropped. Those that expected a better economy fell to near the lowest level on record. I think we got a slower economy coming, but something, we're going to watch it. That'll help our housing and it'll help our interest rates. And even though Jay Powell made the comment that he's not going to cut interest rates, we know the truth, right? I mean, we know Powell will be cutting interest rates. Oh, sorry, don't.
Idiot.
It's our Fed chairman. You can't say, well, I guess you can if it's accurate. I mean, if he would have increased interest rates 3 years ago, he could have done it a little bit and not done what he's doing now and breaking the economy. Have you ever noticed that the Federal Reserve, they never, ever do things accurately, right? They always overdo it. And I always have fun listening to these things because I did go to Chapman College and I was on, I think, the third or fourth economic forecast that they did at the school. I think they're somewhere around the 40th now. I guess I'm old. And, they go too far. They watch this at Chapman and they'll talk about the idea that they don't want, they think they can turn a ship overnight. And it doesn't work that way. You raise interest rates that much, we're not going to feel the effect of those changes until the end of this year. Yeah, and that'll be when we're in a recession. So we're heading that way. But remember, when you're thinking about real estate, home values increase during a recession. Interest rates decrease during a recession. If you're wanting to buy a house and you enjoyed being outbid in January of last year, just wait. You'll be able to do that again by the end of this year. That's the Mortgage Minute, brought to you by our friends at Geneva Financial. When you're ready for that next home loan, Geneva's got the programs and the products. You just need to make a call, 800-306-1990, 800-306-1990. See, I leave it on a good note.